All right, here's part two, and I'm just going to continue to go through this information. And I'm going to start where the promissory note equal the real asset. You get that? When you go into the courthouse, they're talking about real estate. The promissory note is the estate. Your uh, by the way, this is not legal advice. This is just for entertainment purposes only and educational. And this is a book reading. We doing book reading right now. So literally, the, when you sign the promissory note, the bank books it as an asset. In return, the bank credits your account with a deposit, which is their liability owed to you. That's the accounting swap your promise, their debt to you. The house equals the collateral, so the house is the collateral. But here's the catch: the note itself is enough to create the loan, deposit money. The house is not what creates the money. Your house is not what's creating the money, and the note did. The promissory note, the car note, the credit card agreement that you signed. Because, and if you heard me earlier before, an agreement is a contract, and a contract is obligation of the United States. 18 USC 8 says that. And since it's already paid, the house is pledged as collateral through the mortgage or deed of trust. A deed of trust. Promissory note is a is like has value, and a deed is another contract. A deed of trust is just a contract. Uh, they have a declaration as a contract. The declaration is actually like the Constitution. When you create a trust, the declaration is a Constitution. That's why sometimes they can't go into it. If you create your trust right, they can't go into it because they're not privy to that contract. So it makes it hard for them to steal from you. Why collateral? If you don't pay back the note, the bank can seize the house to cover its potential loss. The house secures your promise. But notice the bank didn't give you money because of the house. They gave it because you signed the note. They promised to pay. The house is only there as a backup. Borrower versus owner. This is a tricky part that flips perspective. At first, you gave the bank the promissory note, which is their asset. They owe you the deposit, their liability. So, yes, they owe you money, the deposit, because you gave them the note. After funding, you spend deposit. See, this is what don't happen. You spend deposit to buy the house. Did you? Or did you get it? Did you get the money? It's actually not even money. I shouldn't be saying that. Credits. Did you get the credits? Oh, it's showing up there. You seeing it every day. I mean, especially when you get a bill, you seeing all the credits. It's just that you you didn't get anything. Well, you did get it, but you didn't. You did get it, but you didn't. Because by law they gave it to you, but it's just sitting in an account. How would you get access to that funds, those credits that they actually owe you? Because if you go to the store and get a credit, guess what happens? You get store credit. You get store credit, but you can go in the store and buy another something, and so you want to redeem something. So you want to redeem it for the house like you're supposed to right here. You're supposed to. Now you owe the bank payments on the note because you promised to pay it back. If you fail, the house collateral is the bank's safety net. So if you ever look on your car contract, I know this is my personal experience. It's actually right here. Uh, I'm not looking at it. There's my car note, but I read my mortgage contract, and it always say you give us a security interest. Basically, you giving it back to them. You gave it to them in a contract. We don't read contracts. I didn't read mine, so uh, yeah, we should be marking that out in that contract because we don't want to give something that's supposed to be actually ours for clarity for them to pay our back our deposit unpaid balance. It's a two-way street. Initially, the bank owes you deposit. Over time, you owe the bank repayment. Here's a kid-friendly version of it. Direct the house is collateral, not a source of the money. You can read that. I'm gonna drop down here. So, if the so-called borrower gives the promissory note, which is bank asset, liability owed to the borrower, the bank gets the house. If they default, what did the borrower get? They gave value but received nothing, which I meant to say in contract law, there must be valuable consideration. What is the borrower's consideration? You're asking the exact crunch point that most people miss. If the borrower gives the bank an asset, the note, promissory note, and the congressional record, it says any note. Any note. It doesn't matter what it is. You could put, it says a note, and whatever you put in front of it, it's still a note. Um, that's how you read law, basically. Is and the bank books that asset as an asset, then creates a liability deposit owed to the borrower, what did the borrower actually receive? What did you get? Contract law basic consideration. In contract law, a contract is enforceable only if both sides give something of value called consideration. That's the most important part of a contract. All the contracts, everybody's supposed to be winning, but you know what happens when these people borrow consideration. The signed promissory note, a negotiable instrument that has value, a bank consideration, the credit, deposit, liability. There it is, the credit right there. They issue to the borrower. So the credit they issue to the borrower, which the borrower can spend. Did you ever spend that credit? Even you try if you try to get that credit, they tell you they be all doing all kind of stuff, trying not to give you that credit. I know a lot of people out here talking about a bill is a bill of exchange is also a security, and a security is also could be traded, not traded, but deposited to be to get Fed Reserve notes. By the way, what did the borrower receive? Even though it looks like nothing, here's what the borrower gets in law and accounting. The bank creates a deposit balance in the borrower's account. That deposit and the bank promise to pay on demand legally. That's valuable consideration. The borrower can then use that deposit to buy the house, to pay the seller. You're supposed to be using that to pay the seller. So in contract law, the bank gave consideration by creating the deposit. It's liability to you. So that's a liability that they owe to you. Borrower gave consideration by signing a promissory note, which is, if it's the bank said, "Oh yeah, thank you for the asset. I'm gonna put it on my books as an asset because that's your value." Why it feels one-sided? It feels like the borrower gave real value and only got an IOU from the bank. That's true in a sense, but under banking law, that IOU, the deposit, is the money, or they say money is credit. You can withdraw it in cash, Federal Reserve notes. Yeah, everybody's spending in their back pocket. Every time they go to the store and pull one out to pay for something, that's a Federal Reserve note. If you have one right now and you look at it, it says Federal Reserve note on it. That's what it actually is. And when you're reading law, you have to call things as it is because law is specific. You gotta be specific in law. You can transfer it to buy a house, car, or anything else. You didn't even have to buy the house. You could have bought something else. So the deposit, even though it's a liability on the bank's books, because it wasn't about the house, it was about the promissory note, that one that created value. Uh, on the bank's book functions as valuable consideration to the borrower. Hit friendly version here. In mortgage contact, borrower gives promissory note pledge of house as collateral. Bank gives the deposit balance credit in your account. So it's a credit in your account, which you can transfer to the home seller. Seller gets the deposit, which they can convert to cash to keep it in their own bank. And they take that cash, Federal Reserve notes, and then they put it in their bank, which goes back to the Federal Reserve Bank because every bank is an agent of the Federal Reserve Bank. Borrower gets the title to the house through the purchase. Did you get the title? Nope. You sure didn't get nothing. They holding this over your head like a dangling carrot to get you to send them two sets of federal, two sets of securities. So when you give them cash or Federal Reserve notes along with a bill, that's two forms of securities they just got from you. Then they take that and put that mortgage-backed security and they give it to the investors. That's what they said earlier. And that's what the mortgage-backed security is. And that's can be, you read that from the SEC filings and Security Exchange Act, the Indentured Trustee Act. You can see the direct uh, answer here. I'm not going to read that. We're just going to go down to the next question. What if the bank gives you the consideration, sends a bill, a security, in the mail, then asks you to pay Federal Reserve notes for that bill, then you refuse to pay, they take your house, and then where would the consideration be in this? You're drilling into the fairness loop of how mortgage contracts work. The borrower gives value, a promissory note. The bank issues credit, deposit. Then later, the bank demands repayment in Federal Reserve note, which is what people call cash. And if you don't, they foreclose on the house. Let's unpack this carefully on the contract law and the banking law. Borrower consideration, the signed promissory note, bank asset. Bank's consideration, they get of course, this was earlier. You can read that. So basically, the borrower consideration is a promissory note to the bank. The bank's consideration to you was the credit deposit into this deposit account, which means deposit means unpaid balance. So the unpaid balance, their liability. Liability, they don't like ability. So which balances out their books. You're supposed to be having a balance book too, because if you gave them something as an investor, you invested in that company and you loaned them money, so you have a minus sign on your balance sheet, and then you got your credit out there. You're supposed to bring your credit back to balance your books. The bill you receive, mortgage statement. Each month, the bank or servicer sends, when they say servicer, they means like, for example, Rocket Mortgage is a servicer, uh, Navy Federal is a servicer because they make sure you get your bills every month on time. Uh, Since your bill technically a payment notice, in one sense, yes, that bill is a form of the security, evidence of a debt obligation. So that is the evidence of a debt obligation to you. Represents the contract terms. Borrower must pay X per month in U.S. legal tender, Federal Reserve notes. This is not new consideration. It's simply enforcing the original contract. Here's the tricky point. The bank originally gave you a deposit liability, not Federal Reserve notes, but the contract requires repayment in legal tender. There's the 31 USC 5103, which is United States Code, Federal Reserve notes in the US coin. So the borrower is required to obtain Federal Reserve note or equivalent bank credit to satisfy the obligation. Look what they say here, or equivalent bank credit. So what's sitting into that unpaid balance? Credit for you to use to pay off the house. But they didn't really give it to you, so that creates the double bind. You gave the bank value, the note. The bank gave you value, deposit, but when repaying, you give the bank back a new note. But when repaying, let me read this again. But when repaying, you can't give the bank back a new note. You must return Federal Reserve notes, which is the cash in your back pocket or equivalent. If you don't pay, foreclosures happen, it kicks in. Where's the consideration in this? The initial deal had consideration, note versus deposit. The monthly bill is not new consideration. But that bill is also a mini contract. Also, you can read that in Henry R. Cheesy, I think, about business law. It's the enforcement of your promise to pay, which you can change this to a bill of exchange to make the payment, basically. If you default and they take the house, you forfeit the collateral you pledge. But that actually that collateral is for you to because you gave it to them and now they're using it against you. From your perspective, it feels like you gave the bank a note, they gave you their IOU, then they demanded repayment and Federal Reserve note, the cash in your back pocket. And if you fail, they keep the house. Kid friendly version. There's a direct answer. This is just a short explanation of what I just said. I said, so the consideration was at the beginning. Okay, I get that. Okay, bank credits that they put on the book entry number is the accounting, but did they give you value? Seems like a store credit to me. You nailed it. The deposit the bank creates for you is basically store credit. Let's break this down. What the bank actually gave you when you signed the promissory note, the bank didn't hand you gold coins or even pre-existing cash, Federal Reserve notes. They gave you a book entry. They just went in their computer and typed something in, basically. Debit, asset, your note, value to the bank. So your debit on the debit side of the accounting ledger was an asset, which was your note, promissory note, card note, credit cards, any contract obligations that you have out there. Credit liability was deposit that's that unpaid balance. Deposit means a unpaid balance in your name, what you can spend. So that deposit is not real stuff. It's like going to Chuck E. Cheese's and getting those little. You go to Chuck E. Cheese's and you give them Federal Reserve notes and they give you tokens. Those are not real stuff, which means that if they all give us tokens when we go, which is credit, then how do you redeem those credits? How do you redeem your Chuck E. Cheese tokens? That's what I'm asking you guys to marinate on. They owed before. It's literally an IOU from the bank to you. You can use it to write checks, swipe a card, or withdraw cash because you can use it in this whole system. Federal Reserve system, by the way. But until you spend it, it's just a number in the bank system. So it's just a number. Why it's like store credit. Think of a department store. You return a shirt and they don't hand you cash. They issue store credit on your account. That credit isn't money itself. It's a promise from the store that you can use it to buy things. So I want to buy the house. Why I want to use it to buy the house. I wanted to buy the house that the minute I walked in the door. Why didn't I have that option? Why wasn't it disclosed on in that contract agreement? Why didn't you say, hey, you can buy the house with this store credit? Seems like in contract law they didn't disclose that information. That's what I'm saying. Bank deposits are the same idea. They're not money in themselves. They're the bank's liability. They're a promise that you can use them to get good service by transfer, deposit, converting Federal Reserve note. So it has no value because if I go to Lowe's and I already gave them my Federal Reserve notes and I returned something back, but they gave me store credit. But for that instance, I only can use those credits in that store. But the Federal Reserve System, when you go to a bank, you can use it in any stores. It's broad, basically. Did they give you value? In contract law, yes, because the deposit is legally valuable consideration. You can spend it you can spend it to buy a house, car, food, etc. Even though it feels like they just typed in numbers, those numbers are treated as like a money is actually gold and silver. I want to say currency in the economy. You know why there's high inflation? Because when you give them a promissory note and they go to the feds, they print out the money and you need to balance your books, you have a negative side right here. So you need your credits back so you can balance your books. It's a balance. Balance. Zero gotta be zeroed out. That's what sets offs are. The bank gave you store credit, a deposit entry. You then use that credit to purchase something real like the house. Here's a kid analogy, and here's the direct answer. Yes, the bank gave you value, but it wasn't gold, cash, or something tangible. It was a book entry credit, store credit, that the system legally recognizes as money when it to the gold. So that's what we use these days. So borrow society gave real signed notes and it goes for instrument. You can read all this in UCC Article 3. A bank side gave a ledger entry deposit credit, which functions as money, even though it's just numbers. Pretty interesting, huh? I know this might be dry and dull, but if this really interests me. So if your state is for it, I mean you're really interested and you're definitely liking it because I like the clear understanding of this. But all this information here can be tied to actually laws and statutory laws and contract law. You just have to tie it in for yourself. But right here is just like an explanation of what's going on. So if you get the grasp of what's going on, then you can start picking out the information that you need to know to better understand this information. So basically, continue the conversation by saying, so if they gave the store credit as value and they held the credit in the account and never gave it to you, but you wanted to redeem the credit for the house to begin with, how does that work? Because majority of the time they don't give you access to the store credit. Ah, now you zoom into the key detail that feels like a sleight of hand. When you borrow for a house, you never see a pile of cash, yet somehow the seller gets paid. Let's break down how the store credit system works in practice. Where the store credit lives, when you sign the promissory note, the bank creates the deposit credit in their books. So you gave them a note, they create a deposit credit. That credit is a liability owed to you, but you don't usually see it as the cash Federal Reserve notes. Sometimes you get a loan, you get the cash value, but they still try to make you pay it back. But you gave them this as value, so they already got something in return. Instead, the bank usually directs it immediately to the seller account at closing. So yes, you never actually touch the credit. How it pays the seller. Here's the type of mortgage closing. You sign a promissory note and mortgage. The bank the bank books the loan asset and creates the deposit liability. Instead of leaving that deposit in your hand, they didn't even give it to you. The bank issues a cashier's check or wire transfer to the seller. So you so they gave you so they gave the seller the money. Tyler, that check wire is drawn against the deposit, which is a credit they created to you for you. The seller deposit that instrument into their own bank account and now they see spendable funds. Why it feels like you never got the money? Because practically the bank acted like an escrow agent, holding the credit on your behalf and paying it directly to the seller. You didn't get to redeem it in hand, but you did get the benefit of it. The seller accepted it as payment and gave you the house deed. They ain't get no deed, ain't a title. So legally, you did receive value, but you didn't receive it in your personal account. It was transferred straight to the seller. So if they transferred it straight to the seller, then why you still owe something? Because the bank's acting like an escrow agent, a person that's managing an account basically. They're trustees. They're holding money for you, and they're supposed to be doing what they're supposed to. All banks are trustees. When you're dealing with the public, they are trustees. By the way, the public servants. It ties into the Constitution. We the people. Why banks do it this way to prevent fraud? People walking off the cash instead of buying a house. So, that- okay, yeah, they want to prevent fraud, right? Yeah, sure. But if so, they didn't give me the money. I gave them a note. They gave me store credit that's supposed to purchase the house with, but they didn't give me my title because it got paid with the store credit to keep the system because the promissory note was value. I gave them value for the house for them to give me. I was supposed to got a check with my name on from the treasury. To keep the system efficient, the bank handles the settlement, so you never actually handle the money. I don't want them selling nothing because they don't do it right. But in the account, just but in accounting, it's still considered your consideration receipt because the payment went to the seller on your behalf. Your bank store credit deposit and real values in contract law. They usually don't let you redeem it into your own account. Instead, they send it directly to your seller check wire. You never see them, you never see the money, but you get the house, which is actually being as a bargain. You get the house, but you actually own the house. You didn't, you didn't get the title. They're dangling that carrot over your head to make you pay twice. Not only that, earlier we were talking about mortgage-backed securities, and you heard what happens with that. They take your loan, which is that deposit right here. You remember talking about that deposit? It's unpaid balance. So whenever they create that loan number, it is in a deposit account. Some paid balance paid to you. They take that unpaid balance. They could go to the Federal Reserve. They got several options they can do. Go to the Fed, or they could take that note and pull it in together, uh, uh, mortgage-backed securities, pulling service agreement, and then they can sell it to the investors when you make their payment. So when you give them twice the payment each month, they can pay the investors. Instead, they send it directly to the SBI check wire. You never see the money, but you get the house, but you don't get the house. That's I'm gonna ask him some more questions, but I'm gonna stop it here and we get to continue the conversation later. And if you stay to the end of this, thank you for even taking the time to go through me with this. This is how I learn. Um, um, just by asking the questions. If I don't understand a term, I'll just ask. I can ask Chat GPT or I just look at the legal definition. And we need to know how to get 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 that credit because whenever you pay a note, don't you see a positive balance on that bill? That's credit. Guess where the credit goes to? You remember I started talking about mortgage-backed securities, right? They send it to the investors. What do they send it to you a bill, right? So they actually are paying you. They are paying you those credits from the mortgage. But then you send a Federal Reserve note, which is also a security, along with the bill. Or even you wire transfer them or they debit out your bank account because look at here. They can wire it right out your account or a check. But so when you get the bill in the mail, it's actually if you read the Congressional Record of March 9th, 1933, it says those draft bills or uh or banknotes, banker's acceptance, my bad, are all the securities. Um, let me before I let you go, I got a little bit more time. Let's pull up. Let's see. I'm gonna pull up a congressional records, and I'm gonna give Eon the props of this document. You can go to his website and or just type EEON into YouTube, and you can search him up, and you can go to his. You can find out. I think it's like SecCon 911. He has a document called the New Deal, and this document talks about. The document is about um, Claudette. Oh my gosh. All right. This document was edited and noted by Eon, so this is not my work. I give credit to him. But right here it says the sixth paragraph of this section 18 of the Federal Reserve Act is amended and to read as follows. Upon deposit with the Treasury of the United States, you can A of any direct obligations of the United States. Wait, before I continue, what's direct obligations of the United States? Let me go down here. Then I go back up and finish reading it. I'll refer to section 401 originally upon deposit with the Treasury of the United States of all contract obligations of the United States or any notes. So I'm gonna go back up. Upon deposit with the Treasury of the United States, A, of any direct obligation of the United States or of any notes. Any notes means any notes. It's specific. It doesn't I could put cat notes. If they made something to say cat notes and was able to accept it, then it will be cat notes, dog notes, but any notes. You get my drift. So any notes, car note, mortgage note, Federal Reserve note, drafts, bills of exchange, or bankers' acceptance acquired under the provision of this act, any Federal Reserve bank making such deposit, what are they depositing? These. Any notes, draft, bills of exchange, or bankers' acceptances acquired under the provision of this act. Any Federal Reserve Bank making such deposits in the manner prescribed by the Secretary of the Treasury shall be entitled to receive from the comptroller of the currency circulating notes and blank. What are those circulating notes and blanks, you may ask? They're called Federal Reserve notes in blank because you can pass them on to anybody. Registered and countersigned when which circulating notes are issued against the security of obligations. What's the securities of the obligations again? Notes, draft, bill of exchange of such circulating notes shall be equal to the face value of the direct obligation. What's the number on your promissory note? What's the value that they say on that note is? It's a car note, right? It got a value there. It tells you what the value is. And the United States so deposited as security. There's all securities, and when they issued against the security of notes, draft, bill of exchange, and bankers' acceptance acquired under the provision of this act, the amount thereof shall be equal to not more than 90% of the. That's where you get that. I think that. No, I'm not going to say it because I have to go. I'm not going to say something that I have to do a little further research. Such notes shall be the obligations of the Federal Reserve Bank. So 18 USC 8, obligations of the United States. Why you're paying on obligations that's already been paid? You paying, I like what Mansa be saying, you guys out there paying a bill that's already been paid because people misuse the definition of a bill. A bill doesn't mean what you think it is. A bill is actually mean a bill of exchange. A bill of exchange. A bill of exchange. You can actually see that in the Uniform Commercial Code, or you can look at the Bill of Exchange Act. But if you go to the Uniform Commercial Code and you go, they got a section there that how to convert this bill into Basically a check. It's an exchange. You're exchanging it to something. It's a exchange. This document is really good. Talk, but it took me a while to understand this document. But this actually, it's not too hard to understand, but you still got to go and look at a couple. I say that now. When I first read this, probably it went so far over my head like a boomerang, but it circled back and I was able to get it because I stuck with this information. But uh, but yeah, this is a very important document because this is when everything started, and this is an actual record. It's a record. It's public record. So Congress, if you know the Constitution, they make laws. They have the power to make laws, statutes, and stuff. But they take that. You see, it has house. If I go to your house, if we were playing Monopoly, and y'all have some house rules, right? And I go to your house, right? And y'all had like different rules for the game of Monopoly. That's what Congress is. This is the house rules, but the real original rules is the Constitution of the United States. So we should be operating under that because that's the supreme law of the land. But yeah, this document, I struggled a little bit, but maybe you guys can want to take a pause and just read it here, but you can actually just get this document off the internet from the government website. You can get this from the government website. Make sure you get it from the government website. That those are the records are keep. So people always say that, hey, oh, where do you get this information from? The Constitution. These people make the laws to the Constitution. They we gave them the power. We the people gave them the power to create rules and to basically service us. But statute laws and stuff is just laws to manipulate the original rules. But we, the people, are supposed to govern the government, not the other way around. Uh, that's where people get confused about their fictitious name, which is their all caps name. And I'll do a video on that later on. The, the reason why your all caps name is not you, because um, law is precise. So if I have these rules and this language that they're using has to be precise. All this language they're using here is precise. They're using it for a particular reason. Things are capitalized for a reason. Bill, North Dakota. See how they pronounce North Dakota? That's a proper noun, person, place, or thing. Your name is supposed to be this person, place, or thing, but it's in all caps. And the only thing that's supposed to be in all caps is here's some more important documents of it. This is the President Proclamation of 2039 that Eon put together for this. There's that banking holiday that we were talking about earlier. And then they got the Trading with the Enemy Act in here. Oh, here's the statues. They're the same. Here's the statues that you can go and read. And right here, section 4 right here. No, I think it's title 4 actually. I may go a little bit faster because you can look this up by going there. Uh, you can see there's some, I think it's Title 4. Here it is, Title 4. Remember I just read up there. Upon the deposit with the Treasury of the United States, A, or indirect obligation of the States, or B, any notes, draft, bills, or exchange, the Baker accepts the requiring the provision of the Act shall. Yeah, it's it's some more of that. Right here, somebody put face value there because the promissory note has a face value on there. And this is the statutes here um, that they go through. And here's the emergency power statutes reports. These are the emergency power. We're always on an emergency. The emergency powers is what keeps this in effect. That's why we're already in a state, always in a state of emergency every year to keep that. because they modified it or amended it through the emergency banking powers or the emergency powers. Yes, you can pause this and read it yourself. You see, this is detailed information. This is all public information. It's all public records. Even see here the reference there. And if you go to, I pull up one more thing here. You see, I'm gonna just go a little bit faster. Um, all right, that's it. I want to show you one more thing before I let you guys go. If you're still staying around, thank you for staying around. Sometimes I just we're gonna come over here. I want to do something first. Let's say um all right. This is the Federal Reserve Act. A little bit what I was reading, right? This is on federalreserve.gov. We, NASA loves. If you want to know more about this, NASA does a pretty good job teaching this. This is how you get the notes. And then if you look at here, 12 USC 411, these are the references that you can go and check in those statutes. This is where all this information comes from Congress. They write these laws and statutes, which is kind of like a manipulation of the original laws. So, uh, Section 16, Part 1 and Part 2 is very important. This is the reason why you don't supposed to be denied from credit report. The Federal Reserve agent, which is a bank, shall each day notify the board of directors, Federal Reserve System, all issue withdrawal Federal Reserve notes to be to and by the Federal Reserve Bank to which he is accredited. The said Board of Governors of the Federal Reserve System may at any time call upon Federal Reserve. I'm looking for something in particular. Is it down here? Maybe it's a little bit up in here though. I just read this. The collateral security thus offered shall be notes, draft, bills of exchange, or acceptance acquired under the section 10A, 10B, 13, or 13A of this act, or bills of exchange. Bills of exchange, those are bills that you get in the mail, endorsed by a member bank of any Federal Reserve district and purchased under the provision of Section 14. You can go down here, read Section 14 over here of this act. A banker's accepted purchase under provision. I already said that. Oh, no, I didn't. Section 14 or gold certificates, special drawing right certificates, or any obligations which are direct obligations of or fully granted as to principal and interest by the United States or any agency thereof, or assets that the Federal Reserve Bank may purchase and hold under Section 14 of this Act, or any other assets, federal promissory notes or assets. And right here, in no event shall such collateral security, what do we the promissory note is a collateral security for the Federal Reserve notes to get issued. In no event shall such collateral security be less than the amount of Federal Reserve notes applied for. It can't be less. I already just said it has to be equal, right? I just read that in the other one. They get the notes, but they're supposed to even give it. They're supposed to take that note, deposit it, give it to you so you can pay for the house. They're supposed to get a fee. Their fee was doing this transaction for you, and that's the finance charge that they're supposed to have got. A finance charge is just a charge of the fees that they actually supposed to get only. It's a fee for them to go to the Federal Reserve window for you to get the money from the Federal Reserve Bank, which is the credits. And they're supposed to bring those credits back to you so you can purchase your stuff. But they don't do that. But that's a little bit it. All right, I'm gonna end it on that note. And thank you for taking the time to listen to me learn. And I will also have a little video talking about the all caps name and why it's important and why it's not you. I go a little bit more detailed than that, and how that you have to correct the record so that correcting the record say, hey, y'all been getting my name wrong this whole entire time. I'm the beneficiary of the trust. You're a trustee. Every public official is a trustee, and we're supposed to be using petitions and stuff. But yeah, I can go on and on. But yeah, all right, guys and gals, y'all have a great night.